Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're here to talk about money. And we seem to be living in what could be called interesting times. Or maybe we call them the unexpected times. I'm not sure we would call them the black swan times. I don't think it's that dramatic. But maybe the black cygnet, the little baby swan times. With all the attention on the war in Ukraine, with what's happening with the Federal Reserve, with what's happening in inverted yield curves, with all that's going on, and then wham, Hamas launches their attack against Israel. And Israel responds, and oil spikes up and oil spikes down. Consumer prices higher than forecast with the consumer price index. So what does it all mean? So Al's got some insights on that. We're going to get to that. And we're getting close to Halloween. The ghosts and the goblins from the market seem to be coming out, spreading fear and giving you, the investor, the idea that only they can save you. Only they know what the real answer is. And it's not just the gurus, it's advisors that are prospecting and telling you they have a better way. Something we'll look at in the program. It is ghost and goblin, but it's not real. So let's start. Al, take us away.
Mike, we saw a return to 1973. The Yom Kippur War was called, where Israel and I think it was Iran at the time.
Egypt,
excuse me.
Egypt invaded. It was the 6-Day War.
Yeah, and so it seems like we're back there again from what happened last week. And I guess people are, looking at, I thought oil prices were going to skyrocket on Monday, but they went up, but they didn't go up that much.
The 6-Day War was a lot different because it was over in 6 days.
I know, but the thing is, Mike, back then, Saudi Arabia came out and said anybody that supports Israel, we're going to cut them off.
Yeah.
Right? So oil prices, let's just look at this, went from $2.90 a barrel to $11.65.
Yep.
And so we were already experiencing at the time in this country, we were already fighting inflation. And that just exacerbated the problem.
That and Iran wanted higher prices so they could buy military equipment, so they could rebuild the Persian Empire. All that was going on during that time.
Right. So in 1974, Mike, the U.S. spent $27.5 billion on fuel imports. Compare that to $8.8 billion in 1973.
Yeah. Triple
the amount. OPEC's profits in 74 were projected to be $100 billion, 4 times larger than in 73.
Yeah.
So that's what we're dealing with. That's what they were dealing with back then. But we're not dealing with the same problem today.
No.
Because much to people's disbelief, the United States actually produces more oil than any other country right now. And we can go get oil if we need to. The Biden administration has backed off of drilling for oil, and especially what they call shale oil, drilling sideways into the crust and pulling oil, which has been extremely efficient and really good oil. And our reserves are down. Our strategic petroleum reserves are down, but we still have enough to weather a storm if something did happen.
Mm-hmm.
But that being said, we don't depend on that type of import of oil anymore. And the electrification's caused a little bit of this, but not. I wouldn't say it's that much of it. I would say the fact that we can go get oil other places besides Saudi Arabia. The interesting thing about Saudi Arabia, though, is that they can turn the spigot on and off really fast. So if they do decide to turn the spigot down, it will cause temporary disruption because they can do it so fast. Like people know that Venezuela has more oil than Saudi Arabia, but it's really difficult to get to. So saying going into Venezuela or anything like that's going to be extremely difficult.
And it's a heavier crude too.
Yeah, it is, but it's more or less the difficulty of extracting it is, and then the political problems down there. Nobody wants to really take the risk of putting all that infrastructure down there and then saying, the country's going to take it over from them. So that's a big problem. But just to give you some perspective, 6 years after the 6-Day War, when was it the Iranian Revolution? created higher oil prices. So back in 1980, just to give you some history on the, this is not adjusted for inflation, but oil went to $140 a barrel.
Yeah.
Now it's about $83, $84 a barrel. That's the real dollars. It's not adjusted for, as I said, not adjusted for inflation. So we're still relatively inexpensive on oil right now.
Not $2 a barrel like it was in 1969.
No. Well, I think I remember in 1988 when I was paying like 86 cents a gallon for gas. Not like that.
I know I'm complaining because remembering that gas at one time was like 25 or 30 cents a gallon. In high school, pulling up to the pump and giving somebody 25 cents to get a gallon of gas so you could drive the guy. Yeah.
Yeah. But the issue is if this war lingers on and more countries get dragged in, that's the real geopolitical risk that could drive prices up. Mm-hmm. If Saudi Arabia, if it comes out that Iran, they have speculation that Iran supported Hamas. If it comes out that they actually did, and Israel decides to take the war to Iran, and other countries start to get involved, I think we would see significant rises in the price of oil at that point.
So what does the country do? What happens with the economy? What happens in Europe if that happens?
I think you're going to see, like you saw last winter when you saw Russia cut off Europe, or Europe starting to buy Russian oil, you're going to see prices and people start hoarding and going to other types of energy. Like you saw Germany was ready to turn off their nuclear power plants and their coal-fired power plants and said, that's probably not a good idea. And they turned them back on. That's going to be a reaction, but they'll keep moving towards, electrification is going to happen. They're going to keep moving towards alternative energy. Mm-hmm. It could push that even further. I think it will, but I think there'll be a retraction and people will go back to whatever they can use. Like, for instance, in Germany last year, when was it last year or the year before when that happened, is the price of wood, of firewood, skyrocketed. People wanted firewood, things like that. People are going to do what they have to do to get by, and so that's what I see is going to happen if that happens.
Like COVID and toilet paper, people panic and pay whatever price they have to pay.
Yeah, and there will be that temporary, if this does happen, there will be that temporary oil. I think temporarily oil will shoot way up, way over $100 a barrel.
And so what does that do to the market? What does that do to
the Well, since we're having inflation problems now, it's going to be like 73. It's going to exacerbate the problem of driving up more inflation if that cost keeps going up.
And so would that cause the Fed to continue to raise interest rates?
That's a good question. Who knows what they would do at that point, right? Because what was it in when they were raising interest rates in the late 70s, and when Paul Volcker came in 78, and right before he came in, there was, Warren, what was his name?
Arthur Burns.
There was Arthur Burns, but between Arthur Burns and
William McChesney Martin.
No, McChesney Martin was before that, though. No, before he was in between them. I think his name was Harding. I'm not sure. He was Fed chief for like a year, for like 9 months or something like that.
I don't even remember that.
But they were trying to figure out how whether to do, because unemployment was skyrocketing. Should they back off raising interest rates? And they thought that would work, and it didn't work. Interest rates are still going up. Unemployment was still going up, and they were still having terrible inflation problems. I don't know what the Fed will do, because we've seen this steep rise in interest rates over the last year and a half, but it hasn't done anything to the unemployment market. And that's the real question. What will they do? And their goal is to try to create a soft landing here. But if we see that happen and we see oil prices spike dramatically, $140, $150 a barrel, I don't know how they'll play it from there.
And will it have that big an impact? Is going from 80 to 140 going to have that big an impact?
Well, it's used in so many things that we make, not just the cars we drive, but a lot of other products that we make in production. So it's going to it still would drive cost higher.
Mm-hmm. So how does, I think it's a big question mark out there. Because obviously there's going to be pressure from the Biden administration to push interest rates down.
Coming into an election, yes.
Are they going to try to say oil prices are up, but it's a temporary thing, like they did early on with inflation? It's transitory? It's going to be an interesting time.
It will be, yes.
It's something to be prepared for, something to think about. but not to overreact either.
No, and as you and I talked many times before, it's going to make the markets are going to get scared and be jittery.
Yeah.
The overall markets, but it doesn't mean some stocks are not going to do well.
Yeah.
I sat on a summit this morning, Mike, online with CNBC, and they had this guy on there, Leon Cooperman, who's been around. He's like you. He's been around a long time. he's a stock picker, and he loves to. He just said, "I'm a stock jockey." So he said, "It's going to be a stock picker's market. The broader markets are not probably going to perform. They've performed well this year, but we don't see that continuing to happen over the next, 3 or 4 or 5 years, especially with inflation the way it is."
Yeah. No, even if you look at stocks in general, in the S&P 500, I mean, it was Morgan Stanley, I think, JP Morgan, that looked at stocks for a period of time.
Yep.
And said 70% of the stocks were kicked out of the S&P 500 because they lost money.
Right.
We'll come back after this commercial break. Don't go away. We've got a lot more to talk about.
About money with your AFC team, Mike and Al, on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, I was trying to remember the guy who filled in between Volcker and Burns as Federal Reserve Chief. It was William Miller. He was 1 year and 151 days. That was so short. That's why I didn't remember him.
I don't remember at all. Now, is it because he didn't do much? Is it
No,
because
he
I
just-
didn't remember? Is it because I'm getting to the age where I forget so much
could
that I
be.
get to hide
It could
my own
be.
Easter eggs?
But he filled in a really short period till Paul Volcker was appointed in 1979.
Wow.
Just a
Interesting.
little history
I
lesson.
learned.
That's it.
I
Yeah,
learned.
There you go.
So, I want to shift a little bit and talk about something that you said. It doesn't hurt to take profits.
No, it doesn't.
So that phrase,
No one's ever lost money. No one's ever got hurt taking profits.
that's true. And that phrase goes back, I licensed in 1986. And I heard that phrase a lot. I used that phrase a lot. In those days, we got paid a commission. Every time you did a trade, you would go through the, I built positions, but a lot of people didn't build positions. The most successful built a large position. You'd do one stock 1 month and have a target price, and then the next month switch to a new stock, and the next month to a new stock, and the next month to a new stock. Always because they were the most wonderful thing in the world, even though it just happened to be that month. And then when stock got to a target price, you'd sell that stock, and the entire proceeds would go into the stock of the month. But there were people. There was the old joke that went around, the 10-15 type broker. 10% or 15 days, whichever came first. So, I mean, the idea, and of course, that's churning, but it was a joke that was passed around because there were some people that were so active in moving accounts that it was like 10% or 15 days. And if a stock was up, the comment was always, bulls make money, bears make money, pigs get slaughtered. It doesn't hurt to take profits. And if somebody asked, what about the long term? We were dealing with stocks in that time of Microsoft and Amgen and Oracle and some of the stocks that turned out to be great big winners. And when somebody would say, what about the long term? The idea was, we hit singles. We're not looking for home runs. If you're trying for home runs, you get a lot of strikeouts.
Yeah.
We don't want to lose a lot of money. We just want to make a little profit. I remember there was one of the rookies that broke in a month or two after I got started, who did Microsoft. Bought it at 50, sold it at 60. Waited for it to drop to 50, bought it back, sold it at 60. And then one day it went from 60 to 70. So he had to buy it at 60 and sell it at 70. Wait till it dropped to 60, buy it back, sold it at 70. He continued to do that time after time. And he kept talking to his clients saying, we're making a 240% per year return. 240%. And this is the way he calculated. It would go up 10 points from 50 to 60 in like a month. And now it's a 20% return. And it'd say, okay, 20% in 1 month times 12 months is 240%. I'm making you a lot of money. 240% per year. The reality is, when you bought the stock, you paid 2.5% or 3% commissions. When you sold the stock, you sold it for 2.5%, 3% commission. So right off the top, out of that 20% was 6% or 5 or 6% for the commissions. On top of which, it was a short-term trade. So the client's paying 40%. Most clients were in the 40% tax bracket.
Yes, it comes off as income tax as opposed to capital gains.
Yep. So 40% comes out there. So what the client really kept was about 9%, not 20%.
Yeah.
And had they kept that stock, and Microsoft in that period of time that I was listening to him went from 50 to 150. And I don't know what happened after that. But had he just bought that stock for the client would have paid $1.50 or so for commissions per share at 50. And if you sold it at 150, the client would have paid another $4 or whatever. It would have been a long-term hold.
But tripled his money.
Would have been a long-term hold.
Yeah, so $10,000 would have been $20,000, $40,000. Would have tripled his money.
Correct. And the client kept all that.
Yeah.
If that would have happened.
You know, it's funny, Mike. That book I suggested you to read about Jim Simons, The Man Who Solved the Markets, is a fantastic book and a fun book to read. But one of his early day partners, when they were building positions in commodities, that's where they got their start. And this guy was really good at picking the commodities because they were all mathematicians that sit there with their algorithms and try to pick. His buddy was great at building the position. He was so cheap he couldn't get out of a position. He said, so the story goes that the head Jim Simons had to walk over to his desk one day with the phone in his hand with the broker on and say, sell now, because the position was collapsing and they were losing money. And it was a funny illustration of how to build a position but not wanting to take a profit.
Yeah. Now, there's a certain time to take a profit, but early in my career, before I got into this business, and I've told you the story so many times, you can probably tell it back to me. But in 1972, I bought Advanced Micro Devices at $10 a share. And 6 months later, it was at 30. I sold it for years and years. I said how wonderful that was, how smart I was, how brilliant I was. Mm-hmm. Bought a stock and it tripled in 6 months. How brilliant I was. And then I got into the business, I licensed, and I looked up that stock because not only did I remember it, but at the time I had a stockbroker, and when I wanted to become a stockbroker, I talked to my old stockbroker. I said, by the way, what was the name of that stock? He remembered. And in those days, it was a 4-letter stock, AMDV. Now it's AMD. And when I looked, had I kept that stock instead of not selling it after adjusting for splits and everything, the share would have gone from $10 to $1,756. Mm-hmm. And what I learned from that is, things continue to change all the time. Earnings continue to go up. Revenues continue to go up.
All right, that brings me to a good point then. Let's bring me to another point. Let's drill down on this a little bit more, right? We've seen the market have a lousy 2022. It's done good this year, but a narrow recovery that's widened out a little bit. It's been about 7 to 10 stocks that have done really, really well. And you know the names, NVIDIA, Tesla, Google, I think Apple, I'm not sure, but there's about 7 of them. And so do you think, and we have some of those stocks we've used, do you think those are going to keep running, or do you think that it's time to take profits on some of those that have gone up 100 or 200 or 300% this year, like NVIDIA's gone up with 300% this year?
I'm fundamental. I would have to sit down and look and project, where do I think the stock is 3 years or 2 years or 5 years from now? It may be, when you see a stock go up a whole lot, does not necessarily mean it's out of sync.
No, but I think of NVIDIA, right? And let's take NVIDIA just as an example. We don't see any other chip companies that have that valuation. Right?
Correct.
We don't see Intel, we don't see AMD have that type of valuation. And we know the chip market's cyclical, right? It comes in and they have a great product, so everybody's going to buy, and then that's going to be oversaturated till the next iteration of advancements come along. And so the question is are they justifying their value at $1 trillion where every other chip company is 150, 250, maybe 300 billion?
The point you make is a really good point, because they will have competition.
And I think Intel in particular is moving into that market.
And Intel has the power to do that. Will Intel, the question is, will Intel have something that will really compete or not?
That's a good question.
That's the big question.
Yeah.
You look at the electric car market, you have to question some of the entries and how strong they are. But I mean, in the case of NVIDIA, the tendency is to say they probably will not have a justification of the current price. And that brings you back to the question of value and price.
Yeah.
Any stock is ownership in a company, and it has a value. It also has a price, and the price is what people are willing to pay for.
Right. And it's interesting because I think it was Leon Cooperman said this morning that he said he heard NVIDIA was thinking about buying $2 billion of shares back. He's like, well, wait a second, the stock price has tripled and you're going to buy shares back when the stock price triples? Doesn't really make a lot of sense. Yeah. But
the idea of buying back shares is one of those things that will begin to change over the next year or two or three. Companies have put out a lot of money in bonds. Mm-hmm. They'll tend now to actually redeem their bonds and sell stock to pay for the redemption. But that's a whole different subject and a whole different radio show.
Going down a rat hole.
Going down the wrong rat hole here. No, it doesn't make sense for a company to buy back its stock when it's at an all-time high.
No, that's what I'm saying. It just doesn't make any sense. Why would somebody want to do that? You'd want to buy it when the stock price is cheap and you feel like you got provide some, returns, consolidate earnings per share for the shareholder, and the stock price then takes off, and then it makes sense.
I think the question that it raises is about management and their call.
That's a good point.
Because what you say is correct. You buy the stock back when it's low to give an additional return to the shareholders. When the stock is really high, all you're doing is saying, we want to reward management.
Yeah.
We'll be right back after the commercial break. Don't go away. So we've been talking about stocks and talking about price and value. And I want to return to that idea because Bernard Baruch made a quote, and Art Cashin has paraphrased it in mathematical terms, and I'm a mathematician, so I like mathematical terms. Cashin said that when the market is a perception market. When it believes that 2 + 2 = 5, it'll pay 4 3/4 for it all day long. And my corollary is that when the market believes that 2 + 2 = 3, what they bought for 4 3/4, they'll sell at 3 1/4 all day long. Stocks have a price and a value. And the price, we talked about NVIDIA for a little bit, that's what people are willing to pay for it. It doesn't mean that's the value of the stock. And my hesitancy in saying, is it overpriced or not, is not, I'm not looking at the fundamentals. I'm not looking at what the sales will tend to be, what the earnings are tending to be. And that's where you really begin to see, does the price equal the value? Is the price more than the value? Is the price less than the value? And I think that's a question of the efficient market theory. I believe it's inefficient in the short term and it's efficient in the long term. That eventually the stock prices move up to the real value. And if you can buy at a price that's below the value, you eventually have some upside movement in that stock because you become early in the stock, not late in the stock. And yet most people are really happy when they're buying a stock at a really high price. And the old saying is, buy low, sell high. And most people buy high and sell low. We're in those situations. I can remember a teacher back in 2000 when the market crashed from the dot-coms. She'd been buying dot-coms and had a portfolio full of dot-coms. And what happened to the portfolio is it dropped 98%. She was not a client, never became a client. But she was so devastated by what her portfolio had done, she decided that she was only going to do CDs for the rest of her life. Now, if she lives to be 705 years old, she'd break even. So in that case, there's two things that went on. Number one, she got involved in the speculation, pure speculation. In the dot-coms, it wasn't because the companies had earnings or revenues. It was, at that time, because of the space they occupied on a computer screen. Computer real estate, it was called, or real estate. How much space did they occupy on a computer screen? The more space you occupied on a computer screen, the higher the valuation could be. There were companies like Exodus Communications, and I said it to one of the firms that I work for. Exodus Communications, they had no revenues. They continued to pay money out. They continued to have expenses. And when they were falling short, they would simply go out and sell stock into the market and raise more money. And I said, when they can't sell stock anymore, the company dies. And within 12 months, it had filed for bankruptcy. They had significant space on the computer screen. The problem is they had no revenues.
And we saw the same thing, Mike, in, was it 2020 or 2021 with people chasing GameStop, right?
Yeah.
Company that was headed for bankruptcy, that was shorted by a bunch of hedge funds, and they just made a movie about it called Dumb Money. And people got on these chat boards or whatever, and Wall Street, whatever, bets or something, and drove the stock up from $12 to about $300, $400, $500.
Same.
And talk about price and value. Yeah, it had a $500 price. $500 price. Was it worth $500 a share? No.
No. The only nice thing about that is it screwed the hedge funds.
Yeah, that's the only funny thing about it.
I was happy for that.
I think everybody was. It was funny.
Just because they feel that they're so superior to
But
everybody else.
it's going on today with AI stocks. At the beginning of the year, we had AI stocks. Some of them, I would put them on my watch list, and they jumped. One of them was ready to be delisted by the NASDAQ, and it jumped 600%. It went from like 72 cents to $7 or something like that, or $6.50. Mm-hmm. And then, of course, now it's come back down to reality. It's about $1.10 or something like that. But just off pure speculation and pure this idea that AI stocks are going to save the world, and the stock.
We go through those times. There's
Jumps.
segments of the market, they're real bubbles. I was talking about .coms. You talked about AI. It was only a few years ago there was the same thing happening with the marijuana stocks.
Oh, yeah.
I was worried the whole thing would go up in smoke anyway.
It was Cheech and Chong. Isn't it a Cheech and Chong movie, I think, Up in Smoke?
We go through those times, and AI is going to be like that. And there could be some companies that break through on AI that really have positive things and earn money out of it.
I see. There's one I really like. Is one, and Kathy Wood talked about it this morning. And I've been watching this company, and I look at their balance sheet, and I'm not going to say what it is, but I look at it and I go, you and I think touched on it before, but it has money, it has capital, it's got a really legitimate product that companies can use to be more efficient, and that they use right now.
And that makes sense to look at in detail and see where we are 5 or 10 years from now. Mm-hmm. Can they, in 5 to 10 years, the AI market is going to change dramatically. And yet, it's a technology. I can remember having a company on the radio show as a guest that was in the, not AI market, but the virtual. Mm-hmm. And I went to see the company and wore the glasses. And they had significant positive things because of the virtual reality. And they were talking about marketing to car manufacturers and parts and so on. But there are virtual reality companies that are selling to companies like architectural firms. Want to build a house? Want to know what it's really going to look like? Mm-hmm. You put on the virtual reality goggles and you walk through the house, just like it really will be when it's built. Mm-hmm. That's really positive. And companies that can do that are going to make money from it. But there's going to be a lot of companies that are like the .coms. I mean, the .coms, I saw a business plan of a company that was raising money. It was a 2-page business plan. It was like, we have this great idea, give us money.
Yeah, and it's like when you listen to company earnings reports, and you listen to ones from two from the beginning of the year, and they mention AI 3 times, and you listen to recent ones and they mention it 150 times, and you're like, why do they mention it 150 times? The company sells bricks, I mean, I don't know, There's companies out there that'll just try to jump on the bandwagon to even though they don't have a product or don't have anything that's AI related, but will try to use it to boost their stock price and their notoriety.
Yeah, I can remember during .com times, and I've shared this before too, there was a machine shop that came public, and they had a certain valuation they were going to get. They added .com to their name, and their valuation tripled. I mean, it had nothing to do with the internet, it had nothing to do, but it's that psychology. And people rush to get on the bandwagon without really looking at the questions. How much is it going to make? How long is it going to take to get there? And how sure are they going?
What do they call it, Mike? FOMO? Fear of missing out, right?
Yep.
And people want to chase returns, and the worst thing you can do is chase.
Yeah.
The conversation I had with the guy who thought he wanted to be a client a couple weeks ago, and he just was, he spent $2,500, and the guy told him, hey, these are the 6 stocks you need to buy. And he bought them, and they all went down, and he bailed on it.
Yep.
And then he spent another $1,000 or $750, and the guy told him, these are the cryptocurrencies you want to buy. This is the market. Remember, cryptos were the hot rage a few years ago. Those all tanked. He said, I got out of that. And then he says to me, well, if you told me you had a hot stock, I'd do business with you. I was like, he just got burnt twice.
Yeah.
And, I could have made him a client real easy by saying, hey, buy this stock. But, I mean, I know that the stock's not going to do anything. So, but he's willing to fall gullible to these type of chase the market, not schemes, stock schemes, and chasing what's hot and thinking that's going to work. And it's just not a strategy. It doesn't work. It's not a strategy at all.
There are actual firms that specialize in that. They're called boiler rooms.
Yeah.
And they go after small stocks. The Wolf of Wall Street was about Oakmont Stratton.
Mm-hmm.
That is that type of firm.
Mm-hmm.
This is the hot stock. Don't tell anybody. But if you buy it now at 3, you're going to be in before anybody else hears about it. Oh, yeah. All the other people that are sitting in this room are telling other people the same thing.
Yeah. No, it's funny because I get a call from a guy from Florida that tries to get me to buy stocks, these small stocks.
Yeah.
And I look at the balance sheets because they're publicly traded, so I can look at the 10Ks. So I look at the 10Ks and I look at the ownership, and I look at the ownership is really opaque. I'm like, wait a second, this is owned by some trust, and who is this organization that owns it? And I try to break that apart. And it's really tough to figure out, wait a second, they own 20% of the company. I don't really know who these people are.
Yeah. But they find people that are susceptible to, they want a hot stock. They want to turn 10,000 into $1 million in 30 days. It ain't going to happen. Investing, Jack Album wrote a book. And I think one of the theme of the book is investing is difficult. It's not an easy thing to do. And if somebody finds one stock that suddenly takes off, they're lucky. But most of the time, it's difficult. Don't go away. We'll be right back after this commercial break.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So in 2020, we were up 77%. 2019, up 45%. And the feeling was that we were on top of the world. Whatever we did was always right. We couldn't go wrong. Everything was perfect. Good feeling, go out to dinner, celebrate the success. The market makes you very humble as well. 2022, 2023, it's not been a good time. We're down. And you think, I wish I would have sold. If I would have been really smart, I would have sold when the stocks were way up and just waited for these times to happen. But the reality is, since the time of Peter Lynch, and Peter Lynch averaged 29% per year, that's not a compounded average, that's an average per year. He had down years, he had up years, he had significant down years, but he looked at how he would have done from 1981 to 1991 if he would have missed just the 10 best days out of 81 to 91, the returns would have dropped from 14% per year to 4% per year. Carla Freed updated the study looking at things and published in Money Magazine in 2007. She looked at the time from 1982 to 2001. The Standard & Poor's was up 11.8% per year. 10,000 invested in the market in 82 would have been worth $93,075. Missed the 10 best days, and instead of 93,000, you had 56,000. Missed the best 30 days out of those 20 years, and you had 28,000. Missed just the best 50 days out of those 20 years, and you would have lost money. No, you would have made 15,000. You would be at 15,000 rather than 10. So you can improve by missing the worst days, but you have to guess at which those days are. John Train wrote a book called The Money Masters, talking about Peter Lynch, John Templeton, Roe Price, Philip Fisher, and he offered $10,000 to anyone. You didn't have to put up any money. You didn't have to pay anything. All you had to do to collect $10,000 was to predict the price movement of a stock for the last half of the chart. He would give you the first half of the chart, and all you had to do to pick up $10,000 was to draw the chart out and what the stock price would do. No one ever got the $10,000. I don't know how many people tried, but trying to predict the movement of a stock is something that I don't know of anyone that can do it. There's a lot of people that claim they can. A lot of people will look at the market, buy signals and sell signals and hold signals. And I went through a lot of that in the 1980s and early 90s when I subscribed to a couple charting programs, charted stocks, looked at the technicals, tried to call the signals. I can't remember the point and chart figures company that I went with. It seems like the name was Dorsey or something. Brian Belichick, Brian Belsky. Is that the guy's? He's on CNBC every so often. He was at Dane Bosworth at the time. Anyway, followed him, talked to him, looked at the technicals. It's more than a guess. I would say maybe it's right. Instead of 50-50 being a right movement, maybe it's right 60% of the time or 65% of the time.
That's still pretty good, Mike. If you could bet and make 65, you would still do really well.
Yeah. I think you can do better if you just look at the long term and forget about the short term. And that's what the study showed. That's what Lynch and Van der Heijden showed. That's what Carla Freed showed. And that study by J.P. Morgan Asset Management was repeated from January of 99 to December 31st of 2018. And they looked at what would happen if you invested $100,000. No, if you invested $10,000 during that period of time, the account would have grown to $29,000. It would have tripled in value during those 20 years. But if you missed just the best 10 days, it'd been worth only $14,900.
I think one thing you're missing, Mike, is that people say, the counter argument, if you miss the worst days, right? Then if you miss the best days and the worst days, then you'd be break even or something, right? But the problem is, as you said, it's tough to pick. And the best days and the worst days are clustered so close together.
Yep.
And people don't know. They think, the best day happens on a Monday, the first of the month, and the worst day is the 15, 20 days later. But they tend to correlate and be really close together.
And sometimes they're right next to each other.
Yeah. And so if you get out that one Monday when it drops, like, 1987 Black Monday, right? Drops 22%. I don't know what it bounced back the next day, but I think it had a pretty significant bounce back the next day.
It had some bounce back. It wasn't significantly large. The return was very similar to 2020, where 2020 came back very rapidly.
Very rapidly, right. There's a good point. If you got out March of 2020, that rapid comeback, you would have lost a ton of money.
And there were people that did that. And they sold that idea that we're so smart, we got out in March. Mm-hmm. And they were late getting back in. But just because they missed the real down, they had a pretty good time. Marty Zweig, October 19th, 1987, on Friday for his clients, he had them put 2% of their portfolio in a put. And when the market crashed, that put sort. They ended up with positive returns. And for years after that, maybe a decade, maybe a decade and a half or 2 decades, people talked about his returns. But if you took that one thing out, his returns were not that good. But people would buy. And people tend to focus on other things than returns. You know, you read the book by Ray Dalio, right? Mm-hmm. Pretty good book, right?
It was good. It was a good book. He didn't mention his returns in the book. It was 600 pages, but I didn't see what his actual real returns were.
So 30 years of his all-weather fund, returns are 6.99% annualized return. For his true alpha fund, 1.5%.
Wow.
For 2011 to 2022. If you look at that for those 11 years, the total return, 100,000 would have grown to 117,000. You know, that was the average return for 1 year, not 11 years. But the stories are great. He's a big-time speaker. He's big-time books. But the question is, what are the numbers? It's all about a numbers game. If you're going to be successful, it's all about the numbers.
Well, in comparison to the guy I mentioned earlier, Jim Simons, numbers from 88 to 2018, he's the real deal, Mike, 66%. That's incredible.
Annualized?
66%. Minus fees. His fees were really high. His fees were like, I think at the time his fees were 25%. 5% buy-in and then a 20% profit sharing.
So I have to look at the book. I've got the book. I'm going to read the book. I'll come back and
we'll dissect it.
We'll dissect it. That wraps us up for today. If it's Saturday, we're going to be talking about money. So join us next Saturday. We've got so much to talk about. And these are such, no, they're not fun times.
Interesting
times. And we are wrapping up today. If you missed this program, you'll find us on YouTube. Check it out, YouTube, About Money. If you have questions about your portfolio, and these are times in which to think about it, you can contact Al, 206-903-1019, or Adams Financial Concepts. We'd be happy to talk to you.